If you've ever talked to a mortgage broker, chances are you've asked one of these questions or at least thought about them. These are the top 5 mortgage questions I get asked every single week. But here's the thing, most of them, they're the wrong questions. And today I'm gonna walk you through what should be asked instead. Because when you ask better questions, you get better answers, you make smarter decisions, and you save more money and build wealth faster. Okay, let's go. The first question, I get this all the time. What's your best rate? Everyone always asks this. I don't know why, but it's just natural. We've been trained as Canadians to think that the lowest rate means the lowest payment. But I know, and maybe you know, that that's not always true. I can show you 2 different mortgages, the same amount, and the one with the higher rate can actually have the lower payment. If I put a mortgage fully on a home equity line of credit, for example, the rate's going to be higher, but the payment's lower because it's an interest-only payment. So the lower rate, it's not always the best deal. The best deal, it's the structure that gives you flexibility, cash flow, and long-term savings. Think about it like buying a car. You're not going to go out to a dealership and buy the cheapest car because it's the cheapest. You're going to buy the one that fits your lifestyle, your budget, your needs. Mortgages, they work the same way. So instead of asking, what's your best rate? Ask, what's the best strategy for my situation? Because strategy, not rate, is what actually saves you money. The second question, is now a good time to buy? This one comes up constantly, especially in the current market climate. People read scary headlines and they get worried, but here's the truth. There's never a perfect time to buy. The only thing here is the right time for you. Real estate is going to run in cycles. About every 7 years, we usually see a new high follow a new low. So if you're planning to stay in your home for 5 to 7 years or maybe longer, the short-term market, it doesn't matter nearly as much as you think. What matters more is your life. Are you getting married, having a baby, going through a divorce, moving up the ladder, relocating for work? There's tons of reasons that should drive your timing, not what you hear in the media. You buy when it fits your goals, not when the news says to. So instead of asking, is now a good time to buy, ask, does buying right now make sense for my life and my long-term plan? If it does, then it's a no-brainer. It's perfect timing. Oh, and let's not forget who I am before I get any further here. I'm your host, Scott Sarai, and this is the Mortgage Blueprint Show, where strategy, my friends, always beats rate. This is the show where I break down real mortgage strategies that help my clients and other Canadians build wealth faster, save smarter, and make their money work harder. Let's keep going. Question number 3, it's a classic, doesn't matter where we're at in market cycles. Should I go fixed or variable? And this one comes up almost every single day in my business. And to be honest, it's kind of like asking, should I wear a raincoat or sunglasses? I don't know. It depends on the weather and it depends on your comfort level. There's no universal right answer here. It all depends on your cash flow, your risk tolerance, and how long you plan to stay in that home. Right now, in today's market, fixed rates actually carry a lower cost of borrowing than variables, but nobody, not me, not the banks, not the economists, can tell you exactly what the Bank of Canada will do next. And today's variable rates aren't being discounted as aggressively off prime as they used to be. So really, it comes down to your strategy. If you're planning to sell or refi in a couple years, yeah, you might want the flexibility that comes with the variable rate mortgage. If this is your long-term family home and you want predictable payments, a fixed might be a better fit. But here's something that most people don't realize, and I can tell you the bank's just not going to tell you. You don't have to choose just one or the other. If you and your partner can't decide which route feels right, I actually have lenders who will let you split your mortgage between the two. So let's say you have a $500,000 mortgage. I can actually put $250,000 on a fixed rate and $250,000 on an adjustable rate, and we can see what happens. It's a great way to hedge your bet against market conditions, and you get a bit of the stability from the fixed side and then the potential savings from the variable side. You're not putting all your eggs in one basket with this particular product. So instead of asking fixed or variable, ask which mix of options fits our comfort level and our strategy best. That's how you make the right choice for you. Question number 4, and this one is huge for self-employed Canadians. Your banker or accountants will often tell you to declare a big income so you can qualify for a larger mortgage. And technically, sure, they're not wrong, but they're looking at it from their side of the table. Accountants, bankers, They optimize for tax and compliance. I optimize for strategy and long-term wealth. Let me show you what I mean. Let's pick a number. Let's say it's an $800,000 mortgage at 4.3%. That's kind of middle of the pack in today's market. To qualify through a traditional bank, you're going to need to show about $150,000 in income to qualify. That would give you a monthly payment of about $3,000, $3,900 actually, I guess, if we're going to get specific here. But it also means you're paying roughly $77,000 in income tax. The traditional route here, it doesn't look that great. Let's look at what happens when we use a common sense lender. They're going to look at your 12-month business statements, your company financials, and your overall cash flow instead of just looking at your T4. On paper, sure, you only declare maybe $80,000 to $90,000 in income. Your interest rate, it might be a bit higher, around 5.5%, and your payment would be roughly $4,500 a month. So sure, it's about $560 more per month, but with a common sense lender, you would have paid between $60,000 to $80,000 in income tax. Over 5 years, that means you paid about $33,000 more on the mortgage, just comparing payments to payments, but you saved $84,000 in income tax. That makes you a net ahead $51,000. And then this is usually the part where I say, I don't even want to tell you what that looks like if we compound it over time. Actually, I have my phone here, so let's bust out the calculator. So let's break this down. That $51,000 compounded over 25 years equates to an additional $341,000 cash in the bank for you. That's the power of strategy over rate. Crazy, isn't it? Okay, question number 5. Now this one, it's probably the hottest topic in Canada right now in today's market. Should I wait for rates to drop before renewing or refinancing? We have a record number of renewals coming up in the latter half of 25 and all of 2026. So this question is on everyone's mind right now. Here's how it works. As a broker, I can submit your renewal about 120 to 150 days before your actual renewal date, depending on the lender that we're choosing. That means I can lock in a rate now, today, and I can hold it. So let's say the 5-year fix today is in the low to mid 4s. We lock that in, we get the commitment, and now we're protected if rates rise. Now, this is where it pays to have a broker instead of just relying on your bank. At the bank, they set it and forget it. They send you a renewal letter, they hope you sign it, and they hope you don't ask any questions. Me, I'm gonna watch your mortgage right up to the 11th hour before closing. If a better product comes out, if a new lender offers more flexibility, if rates move, I'm gonna pivot. If rates go up, you're protected by your rate hold. If rates come down, we're able to switch into the better option before funding. That's the beauty of working with a broker who's proactive. So instead of asking, should I wait for rates to drop? Ask, who's watching the market for me? Now, we've been going through this pretty fast, so I have one more bonus question that I'm going to throw in here to wrap this one up. And honestly, it might be the most important one. I get asked all the time, Scott, how much can I afford? And on the surface, that sounds like a great question, but it's actually the wrong starting point. Most banks and some brokers will actually try to qualify you for the biggest number possible because, let's be honest, bigger mortgages mean bigger commissions. But I take a different approach here. When a client asks me how much they can afford or qualify for, my first question back is, well, what are you comfortable spending each month? Because it doesn't matter what the bank says you can afford. What matters is what fits your life and your budget. A lot of families say they want that $1 million home, but they've never seen what the payment actually looks like after property tax, utilities, and insurance. So what I do is I help them reverse engineer it. I start with what you're comfortable paying monthly. I look at your down payment, your lifestyle, your savings goals, and then I work backwards to find the price range that keeps you and your family financially comfortable. That's how you make your mortgage decisions you can actually live with, not just qualify for. So instead of asking how much can I afford, ask what am I comfortable with? And that's the key theme through all of this. When you ask smarter questions, you get better answers and you make smarter decisions. It's never just about the rate, it's about the strategy behind it. So those, my friends, are the top 5 or top 6 questions that Canadians are asking right now and the better questions you should be asking instead. Now, if this episode helped you see your mortgage differently, please share it with someone you know who has a renewal coming up. And don't forget to hit that subscribe button so you don't miss out on next week's episode. I'm Scott Sarai, and this is the Mortgage Blueprint Show, where strategy always beats rates.